Ever wonder what actually happens to the stock market when a war breaks out? It might not be what you think, because the answer's not just about panic. Let's break it down. When war breaks out, the first reaction is usually fear, and markets drop. According to Forbes, after Pearl Harbor in 1941, the Dow dropped 2.9% in a single day. But here's the kicker. Within a month, it had fully recovered. In World War I, the Dow plunged about 30%, but when markets reopened 6 months later, they rallied 88% by 1915. This according to Investopedia. So yes, short-term panic, but fast recovery is the usual trend. Once the shock wears off, markets actually tend to perform well during wartime. In World War II, the Dow gained over 50% from 1939 to 1945. This fact was found on Seeking Alpha. During the Korean War, the S&P rose 11%, and the Dow was up 10% in the first year. In the Iraq War, the S&P gained 26.7%, and the Dow rose 21% in the first 12 months, according to CNBC. So, despite the fear, wars don't always crush the market. They sometimes fuel it. Certain sectors tend to outperform when war hits. Defense and aerospace. Think Lockheed Martin, Northrop Grumman, and ETFs like PPA. After the 2022 Ukraine invasion, the PPA ETF gained 8.6%, while the S&P 500 dropped over 19%. U.S. defense ETFs posted between 55 and 74% gains in 2022-2023 due to global military spending. Energy and commodities. Wars shake up oil supply, pushing prices higher. Crude oil jumped nearly 50% during the early Ukraine conflict. Energy giants like Exxon and Chevron soared. Gold and safe havens. Gold has historically surged during major global conflicts. Investors flee to gold when inflation, uncertainty, or war rise. Consumer staples and utilities. These defensive sectors usually hold strong. People still need food, power, and healthcare even in war. But not every stock does well. Travel and airlines. After 9/11, airline stocks dropped up to 40% in weeks. Emerging markets often see large capital outflows as global money runs to U.S. safety. Consumer discretionary, spending tightens, luxury goods, apparel, and non-essentials get hit first. Here's a weird one. Studies show volatility drops once a war is underway. That's called the war puzzle. Markets expect chaos but get certainty, predictability, and government spending. Here's what to look out for during wartime investing. Diversify your portfolio. Watch defense, energy, and gold. Don't panic. Recoveries often happen faster than expected, and always think long-term. If you want me to break down specific stocks or ETFs during conflict, let me know in the comments. Also, grab your free stock with Robinhood and check out the trading journal I personally use. Both are linked below. This video is for educational purposes only, not financial advice. Always do your own research before making investing decisions. Thanks for watching, and stay sharp out there.